Dear students, now we're going to learn about interest rates. It's very important because it will help you understand foreign exchange markets better and also make better decisions when it comes to managing cash flows. See you in the video. This video will cover international parity relationships and forecasting. Parity relationships in international finance are economic relationships which help to explain the exchange rate movements. This is known as purchasing power parity, PPP sometimes. The second parity relationship explains the impact of change in interest rates between the countries to change the interest rates in. Understanding these relationships will you better understand not only the financial markets, but it will help you come up with correct conclusions when you do forecasting of future sales or future expenses. Some of these parity conditions are when the prices are in equilibrium. Conditions that established linkage between financial prices, like 2 or 3 or several major currencies, in absence of arbitrage. The effect of arbitrage on demand and supply is to cause the price to realign so that no future risk-free profits can possibly be made. Interest rate parity, IRP, is an arbitrage condition that I just mentioned that must be held when international financial markets are in perfect harmony. The law of one price means that $1, if that $1 is equal to €1.50, and that's harmony, it cannot be $1 equals $1.50 or €1.53, because that means that it has an opportunity for arbitrage, and that disappears immediately because it's a risk-free return. Purchasing power parity is when the exchange rates between currencies of two countries should be equal to the ratio of the country's price levels. And it flows back and forth. So sometimes it makes sense to import from Europe, and sometimes it makes sense to export to Europe. That's a part of international trade and the levels of currency. The Fisher effect is an increase or a decrease in the expected inflationary rate in a country will cause a proportionate increase, alternatively a decrease, in the interest rate in that country. So, if inflation is up in the United States, but the Federal Reserve is artificially keeping it low, well, what happens? It would result in that investors are unwilling to lend money to the United States when it be forced, and then that way it will force the interest rate to go up anyway. That's why when you look at the bond market, the interest rates are shifting up and down non-stop. So just because the Federal Reserve might set interest rate as 0 doesn't mean that that is the going rate in the market. Now, China has been accused to artificially keep their currency value very low. And that would then encourage exports from China. However, they're using their currency to, for example, go out and buy other assets, for example, bonds, U.S. government bonds, but also commodities like gold and silver to make their currency stronger. What I mean stronger in this case is that there's a backing to their currency. They can also use dollars to buy oil, for example. What typically happens with other countries is that if we buy a bunch of stuff, say that Europe was exporting all kinds of stuff to us and we're giving them a bunch of dollars, eventually they will take those dollars and buy goods and services from the United States, and then the money flows back and forth. So it's typically not sustainable in the long run to have a currency artificially low. China is able to have it artificially low because they have pegged it to a certain ratio. Now, a lot of the money is reinvested, and there's only so many things that they can do with US dollars. One, they can lend it out into the dollar market and the euro dollar market. That's US dollars that are up for lending for people that have obligations in US dollars that they lend out in Europe. But they can also send over students to the United States so that they get educated here. They don't have that many universities in China. It takes a lot of hard work and effort to build up a university and educating enough professors to actually handle that university. So sometimes it's less expensive for them to actually send Chinese students to the United States and pay for the education here than actually build a college or university in China. Now, if the Chinese would decide to float their currency would appreciate in value and make it more expensive to manufacture in China. And that means that a lot of companies would have to decide, will we maintain factories in China, or should we move to Vietnam, Kenya, or Cuba, for example, where price levels of low-skilled but very trainable employees and hire them to build the products that then is exported to the United States. Efficient market approach. Now let's look at different types of way of having an analysis of the market. You can have a technical analysis which looks at past data to predict the future. It's like looking backwards when you're driving on the highway to predict where the road is going. The efficient market approach takes into consideration all private and public information, and that's typically considered the best way to go. Another way is the random walk hypothesis. That's a suggestion that today's exchange rate is the best predictor of tomorrow's exchange rate. Well, there's a little bit flawed ideas right there, because it will be an assumption that paying attention to what kind of weather it is today to predict tomorrow. So if I used yesterday's prediction for today, I would say it will be cloudy. But today, we actually had sunshine and snow. So it doesn't always work. But then we can say maybe it's just an April effect. Now, a fundamental approach is very time-consuming, but typically very predictable. Not only does it consider all private and public information, but it considers money supply, velocity of money, the relative national outputs. It creates a mosaic picture that offers a very sophisticated view of the world. To learn how to do that takes time and effort. That means that you have to practice it every day and master a lot of things, not just data, but also understanding how politics and constitutions work in different countries, so you know whether or not when a politician comes out and says something, if it really means anything. For example, a prime minister typically has full backing, 100% of whatever party is in power. Whatever the prime minister says is going to happen. However, in the United States, with the president, if he or she says, this is what we're going to do, Congress and the Senate might say, we're not going to do that. And in that case, it won't. Volatility. Benjamin Graham, the professor that taught Warren Buffett everything, and the author of The Intelligent Investor, a book that you should read, by the way, mentioned that in the short run, the markets act like a voting machine. But in the long run, the markets acts more like a weighing machine. So in the short run, they might have a hissy fit. So the stock market might say, I don't like what President Trump said, or I don't like what President Obama said. So that might mean that the stock prices will go down. But that's kind of irrational, and it is a hissy fit. And soon after that, the prices will bounce back up again. On the other hand, they might say, I really like what Trump said, or I really like what Obama said, and causing the presidential statement to rally the market. But then again, the prices will drop. In the long run, it's the financial results that matter. Will we make money? And that's the question. So that means that we have to figure out how to do valuations. Valuation is always forward-looking, not historical, forward-looking. What money will we make in the future? So initially, when we had the coronavirus depart from China and hit Europe and then come to the United States, and the United States said, hey, we're going to close for business. Just like that. It caused the financial markets to drop an insane amount of money faster than it's ever done ever in history. And it went down from, Dow Jones over 30,000 down to under 20,000, and things looked really horrible. But then the president and the administration said, this is what we're going to do, and had a plan. And then Congress and the Senate voted through a stimulus package, bigger than ever. And the communication came out and said that not only will the pharmaceuticals be able to figure out how to get a vaccine by at least, September, October, out to people, and we will have good results whether or not those vaccines will work sometime in the summer. So we start seeing the light in the tunnel from a financial point of view. And once they see the light in the tunnel and they know what to expect and what benchmarks to move to, they look 6 months out in the time horizon. And based on that, they say, we're going to survive. This is going to work out. And they change all their models, how much money that the companies would have lost. Maybe they lost a full quarter, so they just adjusted by a quarter of annual outputs and sales and all that. But then they can calculate what that would be in the future, given that we lost a little bit of momentum. And so the stock market goes up, and everyone's like, oh, I thought we were dying and now the stock market is going up. I don't know what's going on. It's because it's forward looking, not paying so much attention to here and now. So when you look at the valuation, different things that is incorporated is, what are the current expectations of the future? What are the behavioral biases, technical effects, tax effects, correlation with the broader market, stimulus packages, and so much more. So when you screen for opportunities, you need to set up a bunch of requirements that you hold and say, this is how I will screen for opportunities. These are my expectations. Focus on the industries that you know well, because you probably have experienced an industry your entire life. You can don't underestimate the value of what your parents did for a living, for example. So if your mom and dad were in the business of manufacturing and selling things that were imported from China to the United States, you indirectly, as a child, learned what they were doing, which means that you have probably a better understanding of it than you give yourself credit. Or you focus on the industry that you have chosen for your profession. Random approach. Now this is a funny one. They used to always have a little monkey that showed up from, one of the zoos or something like that in New York. And they would take this monkey and they would put up a Wall Street Journal on the wall and give this monkey a bunch of darts. And the monkey will throw these darts on the newspaper, and whatever stock that dart hit, they decided to buy. And then they compared that result as a very sophisticated way of figuring out what stocks to have in a portfolio. And then they compared that to what the professional money managers did on Wall Street. And the irony is that at times, the monkey was actually outperforming the professional money market, the money managers on Wall Street. So sometimes it's much harder and more sophisticated than we could even imagine. Now, research based on news, that's what the voting machine is. You can trade news. It's very good if you're a day trader and you don't hold your investments longer than, less than a trading day. Other ways of doing things is just follow what other investors do. Just look up, what stocks do Warren Buffett buy, and then buy those. Or you can actually use quality research services or do it on your own, which takes a lot of time, but if you hire someone to do it for you, it will save you some time and you can draw conclusions from that. This is what the goofy things happen for large Wall Street firms, is that they will actually have like Goldman Sachs and say JP Morgan Chase. They would do research on different stocks, and then they would sell that research to the other investment company. Now, why would they do that? Well, there's old rules based from the Great Depression and the security exchange rules that came in place in the 30s and 40s that forbid bank holding companies to use their analysts to trade on. So they have to have a watertight shell in between that, because some of this research will actually impact markets. So how do you get around that? Well, if I do research on McDonald's, you can do research on Kentucky Fried Cheese, or chicken, I mean. And then we'll sell the research to each other, and then we can trade on that. So you might say, wow, I could move my money to a foreign country, and by doing that, I can invest at a higher interest rate. Well, assume that you try to borrow $1,000 at 5%, then you trade that for euros at the spot rate right here, and invest that at 5.5%, then hedge the forward and buy a forward contract and see how much money you will get sometime in the future, and you will receive 1,034 based on that. Plus you owe a little bit of money, and once you've done all of that, voila, you might suffer a loss. Now, if you do it the other direction, maybe that will be a positive thing. So it's not necessary that you would actually make a profit by moving your money at the spot rate, buying, say, pounds or euros, investing in a bank there for 6 months, and then buying the forward 6 months out to convert that money back to US dollars. Those are some of the rules that you don't necessarily make money on that. You have to find other ways of doing it. However, it could be a great way to hedge your risk. And accountants really love knowing what will the price actually be. So if you can tell them, we bought the spot rate and we're going to move the money over there, or we bought the forward rate and decided to put the money in our bank in the United States for 6 months, and then use the forward contract that we bought today for 6 months from now, and then invest at that rate. Or you can just let it float, where you have the stock or your money in the bank today for 6 months, and then buy the spot price in the future. All those different things you need to map out and plan, but in the best cases is that you will actually simply make up a policy that this is how we will do business, this is how we pay our bills, and this is how we keep our accountants sane. Now, when would you use this? Well, if you placed an order for an expensive piece of machinery that you have to pay in full in 6 months, but you did a down payment today on, you can decide how to pay for that machine and how do you peg that price. Because you might risk that your home currency that you're actually paying with, that currency might depreciate against other currencies, meaning that other currencies will become more expensive, making that machine more expensive to buy. And that's why you need to pay attention to how to do these kinds of trades. So some of these long-term uncertainties can simply be the economy, demand in a specific market, currency changes, exchange rates, competition, commodity exposure, legislation, unions, environment, and now we have to price in pandemic viruses and war. So that means that not only do you need to understand what kind of virus it is, you need to know, is this a virus A, B, or C, and how will that affect people? And how dangerous is this? How can we plan for it? Or is it not a virus? Maybe it's just a bacteria. What is a bacteria versus a virus? Well, if you have strep throat, you have a bacteria infection. That could allow you to take antibiotics. But a virus, you have to take an immunization. You know that you're going to a weird place when you have to take a lot of immunizations. If you go to Africa, you might have to take, I don't know how many, I was going to say hundreds of shots, but it's probably, you know, a handful of them. And they're probably not all nice. So over a 10-year period of time, we should expect that we have some sort of disaster inside of this risk group. We will have some war, we will have some struggles, we will have some viruses going around, we might have some strikes, new laws that change the way we do things. All of those things need to be baked in to your risk premium when you decide to take on a project and discount it at a rate of return, your internal rate of return, whatever that might be. Sometimes you just make it up and say, hey, I have to make 30% on my money. And then you take that cash flow that you're expecting to receive, discount that at 30%, and if you still make money, then it should be worth the risks that you take. I hope you enjoyed this video, and if you did, give me a and like the channel so you get the best of updates from me as I post them. Also, feel free to write a little comment and say what you wish you saw in this video, and next time I will re-edit this. I will make sure that your requests are answered. See you soon. Take care.